Hello, I am Debbie Carter, and I am Regional Vice President for Region 4 of the CCIM Institute. Also included in this presentation is Max Hamady. He's our VP for Region 6. Region 4 consists of CCIM chapters in Texas, Oklahoma, and Louisiana. Region 6 is made up of chapters in Tennessee, Arkansas, and Mississippi. We are so happy to present to you today commercial real estate opportunities in Regions 4 and 6, the resurgence of secondary markets. We're happy to share this webinar with everyone in the industry today. For CCIM Institute members, this is just one of many member benefits that are designed to help you adapt and thrive in 2021 and beyond. Joining us today is CCIM Institute Chief Economist K.C. Conway. He holds the designations of CCIM, CRE, and MAI. K.C. is going to discuss the factors that are bringing secondary markets and Zoom towns back to the forefront, including the current trends, what's driving them, and how you can set yourself up to tap into the commercial real estate opportunities in your regions. This is some exciting information that you haven't seen before. So sit tight, you're gonna really enjoy this. Feel free to ask questions throughout using the Q&A tab. Tim Wheeler, First VP for Region 4, will be available after KC to answer any questions that you might have. If you're experiencing technical difficulties, please use the chat feature to ask for help with that. The recording and accompanying presentation will be emailed to all registered attendees. KC, welcome and thanks for joining us today. I'll turn the show over to you.
Great, thanks Debbie and everybody from Regions 4 and 6, over 100 people in the middle of the summer. This is awesome, so we'll jump right into it here. I'm going to start with a piece of good news, bad news. There is a new bug out there that we've got to pay attention to. It's not COVID, it's not the Delta strain, strain. It is called inflation. So you never know what I'm going to find for material in a slide deck. I was walking with my son and our little beagle dog in the park the other day and ran across this horn-nosed beetle, and I thought, you know, this has got to have some applicability. So this is our new bug that we're going to have to pay attention to, not only this year, but I think into next year, that has real implications. Whether you're in a big MSA or a secondary MSA or a Zoom MSA, inflation is going to affect all of us. So speaking of inflation, let's look at the news that we got yesterday. So I don't know why the Fed can't find inflation, but it's everywhere I look. So the newest data on the CPI came out, and the year over year was up 5.4%, almost 5.5%. And the month over month, just from May to June, was up almost a full percent, 0.9%. This is really concerning when we start getting to these levels. And I'm not in the camp that this is this new made up term by our current Fed chair, Powell, transitory inflation. So I love how when Rick Santelli and Steve Leisman get into a little battle, they were on that a little bit yesterday. But also we received a couple of weeks ago the new producer price index, and we also received right before that the personal consumption expenditure inflation, and each of those are running almost 6.5%. So inflation is there. This is the new bug we got to pay attention to. A couple of slides I grabbed over the last few weeks. This was Jamie Dimon. They released their earnings yesterday, and he may be inclined to let people work at remotely now when he's seeing the inflation numbers. But even Jamie Dimon is now in the camp that there's a very good chance inflation is here to stay. This is not transitory. And then, you know, when I put these slides together, you know, I was looking at where the 10-year is. The 10-year is at 135 today. It got down to a 125. And you got to be scratching your head saying, if we have inflation and we know the Fed's going to probably have to move sooner, why is the 10-year going down and staying so low? And the answer to that is quite simply, it's Fed intervention in the bond market. The Fed is the high bidder on these bonds, and they're buying the rates down to try to keep everything stuck together. So I'm in the camp. We have systemic structural inflation. It's starting to look a lot like what many of us that are my vintage went through in the 1970s, 77 to 81 during the Jimmy Carter administration. Inflation then, the annual inflation rate was about 6%. And we saw the prime interest rate go all the way to 21% by 1981. So we're already at those levels that really rattled the 1970s. An item that I look at that has it's translatable to your local MSAs is the ENR, Engineering News Record, Constructionomics section they do each month. And so this was showing back in just April, where we were running, 4% on construction and building costs up over 6%. They have an MSA index that shows it by MSA. So you can look at a large MSA like Atlanta compared to which the year over year is running 7%, almost 8%, Baltimore 12, Birmingham only 4%. So you can look this up. And on the left side there, I pulled from Bill Bonner some of the numbers he was pulling together. There is one note here I'll note on lumber. There is a piece of good news. All of the lumber price escalations and increases we've had this year have now completely reversed. And we're back to the same lumber prices we were a year ago. That's due largely to the NAFTA 2.0 or USMCA agreement that Trump concluded before he left office. So we're starting to get a lot of that lumber coming in from Canada. But look at gasoline. We all know if we're out there traveling in summer, gasoline prices aren't around $2 a gallon anymore. They're well above $3. And look at key commodities that are involved in housing and construction, like copper, up 80%. So it's everywhere. This is a neat graphic I ran across that showed how National Association of Realtors put this out on how much more expensive it is to build a house. And so I thought I'd pick some items that maybe we don't think about as much as, the headlines get in lumber, but look at paint. So if you just want to refresh either the paint on the outside of your home or some rooms inside your house because you're tired of looking at it being at home with COVID, paint, just a gallon of paint is up almost 70% from a year ago. Appliances. My recommendation of any of you that might be selling a home here this summer or this fall, sell the home without the appliances included, because you're not going to be able to get new appliances very easily, and it's going to shock you what the prices are. But appliances are up 65, 70, 80%, and you're looking at months of delays to get a new appliance. All right, so where I want to go with this theme and this that we've got for you guys today, and looking at the Zoom MSAs and translating what's going on macro in the United States and across states and how they relate to your two regions. So many of you remember at the beginning of the year, and beginning of every year, I talk a little bit about the moving reports, the migration reports by U-Haul and United Van Lines. So here's the United Van Lines one, and this one in particular showed. Sorry, the United Van Line ones. So it showed in your region, Tennessee, and look at that, Arkansas in the top 10 were two of the top 10 states that had the most net move-ins in the United States last year. So I spoke recently, about a month or two ago, to the Arkansas chapter, and Randall Moore had me speak. And so some of you might remember this, but sometimes we forget in your region that some of these states are actually doing pretty well. And so Arkansas is one that, it's kind of like Rodney Dangerfield, just isn't getting enough respect. And so we might have guessed Tennessee, but we might not have guessed Arkansas. The other thing is the reason people moved, according to United Van Lines last year, was a new job or transfer. So if we went remote or we lost our job, and then 27% moved to get closer to family. They doubled up with family members, mom and dad. So let's look at the next one. This is the U-Haul one. So Tennessee came in number 1 for 2021. This was largely due to all the Amazon HQ2 hiring. Many of you remember, those of you in Tennessee remember that Nashville and Boston were the two cities that got the big IT tech jobs in the Amazon HQ2. They picked Boston and Nashville. But look at Texas. I want the Texas folks to pay attention to this. The moving companies give you respect and know what they're doing, but we're going to get to the CNBC top states for business that were released yesterday, and Texas got no doggone respect, nor did Florida. But in your region, Texas didn't. But then look at Arkansas and Oklahoma. So many of you don't think, we go around the country, people don't think much about Oklahoma being a very significant state. But Arkansas and Oklahoma, number 11 and number 14 in terms of most net move-ins. Now, Louisiana is another important state in your regions, Region 4. And Louisiana fell largely because of hurricanes. Imagine dealing with 30 named storms, which is what the Gulf region dealt with last year. We had to go all the way to the Greek alphabet. And so that creates a lot of disruption and people having to evacuate and move out and wait to rebuild. So I would be a little bit cautionary on any conclusions about Louisiana. And let's please hope we don't have that many storms this year, although we've started off with the most active start of a hurricane season than I think we've ever had before. Most number of storms this early in the season. The next one is, let's look at the new census data and look at what the census is telling us about where people are moving. So in your Region 4 and 6 regions, what you can see is obviously after Texas, which had 15.9% net population growth from 2010 to 2020, which was in the top three for the whole country. You then had Tennessee, almost 9%. Look at Oklahoma at over 5.5%. Here we go again. Oklahoma and Arkansas just not getting the respect they deserve. So the census data, really spending some time and looking at that, is going to tell you some important things about the growth in your markets, the health of what should be there for commercial real estate, given the net population in migration. We're going to go a little bit deeper into this by state in a minute here, but this new census data, very important to be spending some time and looking at that. I've got a couple of notes over on the right there that even though we grew from 309 million to 331 million people as a nation, this is the slowest rate of growth in any 10-year period that we've had since 1940. So we just aren't having the big population demographic growth that we had in the 1940s, 50s, 60s in the United States. The other one to pay attention to, because this will be very important coming up for the midterm elections and the next presidential election, is that since 1940, there's been a net shift of 84 House seats to the South and Western regions of the United States. So in your region, you're gaining population, you're gaining House seats, and are gaining political power and influence particularly in the House of Representatives. So that's an important thing to be paying attention to. All right. Remember, I always put the links there. This is another one, the American Legislative Exchange Council, ALEC is the acronym, ALEC. And I love this because what they basically do is they analyze the states and they look at how much they spend, do they have deficit spending, how much do they tax to pay for all the things that they're spending on. And their general theory is that states that spend less and states that tax less tend to have higher growth rates than states that tax and spend a lot. So let's look and put that to the test. Look over there on the left. Oklahoma, finally getting some more respect here. Number 3 state in terms of how the American Legislative Exchange Council looks at you in terms of fiscal health and having a good balance between what you spend and then what you tax on. Texas, we know with between Texas, Tennessee, and Florida, with your income tax situation, that you tend not to tax a lot, but you do spend money and you spend it wisely. But Texas was number 9, Tennessee number 12, Louisiana. So look at Louisiana with all the things it's had thrown at it, the hurricane storms and everything else. Look at where it bounces at in the top 25. And here's Arkansas, also not getting the respect it should get in the top 25, and even Mississippi, that we always, all we hear in the media headlines is you're in the bottom 5 or the bottom 10 in every category. Well, here you're in almost the top half in terms of fiscal health, balancing that spending versus the taxation level. So for your region, this is phenomenal. When I speak to other regions, it has not been the case that every one of your states make it essentially in the top 25 in this ranking here. So very, very good. And except for one, all of them really in the top 25. All right, so we got some news yesterday. CNBC does this annual annual top states for business, and it started out pretty good years ago. It's gotten a whole lot more political. The current one that they released yesterday, they named Virginia as the top state. for business. It was the second year in a row they named Virginia. And when they interviewed the governor, all they talked about was, ESG matters and diversity. And I was like waiting for, when do we talk about business? And so I was a little shocked, because guess what state didn't even make the top 10? Florida. And Texas. You guys really got disrespected. You got your worst ranking in the entire history of the Top States for Business series at number 4. Give me a break. You look at the metrics from Texas and Florida and look at whether it's business formations, low unemployment, job creation, you name the metric. And I'm sorry, Texas is in the top 3, Florida's in the top 3. So Texas, I think you really got robbed. I did a post on LinkedIn, and I gave this year's Top States for Business a barbecue sauce award. Virginia's a good state. It's a growing state. It's definitely in the top 5 to 10 range. But I'm sorry, from when you look objectively, it's just factual business and economic metrics. Virginia is a head scratcher for me to be number 1. North Carolina, Utah, Tennessee, I all agree in the top 5. I've been talking about Utah for a long time. And so then go over on what's in the bottom, on the right side there. So they had Arkansas in the bottom. They had Louisiana, they had Mississippi. And I'm going to talk about each of your states and what I think is wrong with this analysis. The reason I point this out, this gets a lot of media attention. It goes across to investors outside of the United States. It goes into pension and institutional investors where they deploy capital. And I think it's going to be very important for CCIMs and particularly respective regions to be able to understand where this methodology is flawed and why some of the states in your regions really didn't get proper accreditation for what's going on there. So let's look at that. Let's start with Texas. So Texas, you're ranked number 4, but you have the second biggest GDP in the United States. So I'm a head scratcher. This is Site Selection Magazine, and they do a really good job, very objective. They don't get into the politics at all, and they do an annual State of the States. And so this came out earlier in the year, and they put their key metrics like your overall business tax climate, your rank for higher education and R&D expenditures, your career workforce readiness, the briefcase item. And so let's look at where Texas, where you ranked really high. So number 3, research with a little microscope, higher education and R&D expenditures. This is what companies want. This is why companies relocate today to secondary MSAs in particular states, is they need that skilled workforce, they need a ready pipeline, and they need those universities to be able to doing supportive research and development. So Texas, you're number 3 on that. You're number 2 in GDP. I hadn't heard anything that adds up to number 4 yet. Go down to number 6, you look at electric power. Now we know there was a little problem this winter that you had, and it had more to do with kind of the maintenance and the readiness and the winterization of a lot of your grid, but I'm sure all of that is being taken care of. But companies are also looking for where it is affordable to operate and do more electricity. And then number 6, fiscal health. So companies don't want to deploy capital assets into states or to cities that don't have good fiscal health, because they don't know what the tax situation will be. They don't know what will happen to that asset and whether they can continue to use it. So Texas, you can see my comment at the top there. You take these objective numbers and metrics and try to reconcile these from site selection with CNBC's number 4 ranking. And it leads me to believe on a number of factors, Florida being left out, even at the top 10, but the treatment of Texas as this is going to be one of my annual barbecue sauce awards. And as most of you know, my barbecue sauce stands for the polite way when you're in the South to basically calling BS on something. So I grew up in Colorado. We were very candid, but being in the South for almost 40 years, I've had to learn to be a little more delicate. So barbecue sauce is my politest way of calling BS on something. So hopefully everybody in Texas feels a little bit better about the perspective here. Let's look at Oklahoma. So what I did here, so at the top there, I put the top states. Oklahoma came in with a number 32 ranking for 2021 in there. And let's look at the top. So I pulled the key rankings up there. Oklahoma is ranked by CNBC as the number 1 place for the lowest cost of doing business. So how do you come up with a number 32 ranking when you're the least expensive place to operate business? Now, part of the answer is the yellow arrow. CNBC included a new category this year, and they cloaked it real cutely called life, health, and inclusion. This is code for ESG, environmental, social governance, and DEI, diversity, equity, and inclusion. And you can see that they gave Oklahoma, they say, you guys aren't very ESG or DEI. So they gave you a number 36 ranking, which is outrageous. I spent a lot of time in Oklahoma. I don't get that impression at all. I find you're a very inclusive state, very diverse state, especially in business. So let's go down and look at some of the categories. Let's look where you rank number 2. So Oklahoma ranked for lowest in industrial electric power. So again, this is a critical item when we look at utility costs, the demand for electricity, all that's going on in our factories, e-commerce, what powers these e-commerce warehouses, it's all electric. So that's a huge item to be ranked very high on. And then look at on the number 11. Number 11 at the top, the briefcase, that's workforce readiness. You have the workforce that companies and skilled companies and manufacturing companies are looking for. And the other one is fiscal health. So when you add up all of these items and you look at low industrial electric power costs, fiscal health, workforce readiness, how in the world you come up with a number 32 ranking for Oklahoma? I just scratch my head again. It's one more reason that I give a barbecue sauce award to this one. So hopefully, again, you in Oklahoma, take this information, put it in your packages, discuss with your clients. When you're doing a brokerage package, when you're doing a capital markets package, make sure you're sharing this information, because if we as CCIMs who are well respected don't get the correct story out, more of this new category of life, health, and inclusion overriding everything business and economics is going to prevail. All right, let's go on and look at the next one. Let's look at Louisiana. So look at Louisiana, a number 44 ranking. Well, all the things you guys have endured, how important the Gulf Coast region is, your ports and everything else. And so how they reconcile that with a number 3 ranking for the lowest cost of doing business. So again, this is what companies are looking for. This is what site selection, they're looking for, that cost of doing business. And look at where you rank high. Number 1, where you rank first is in electric power cost generation. So I put a little note at the bottom. Louisiana, you need to start marketing yourselves as the place where all mining for Bitcoin and crypto should be, not in Washington State. Washington has very inexpensive electric power, and so much as well do we in the Southeast. But Louisiana, you have the cheapest industrial electric power rates in the country. And then when you look at number 8, it's workforce readiness. So you don't get the respect that people don't realize the skilled work set that you have and that you are producing in the state of Louisiana and have ready for companies there. So I don't buy the story of a low number 44 ranking in the top states for business, and just look at their own scores. Number 3 for cost of doing business, then look at these numbers where you rank 1 and 8 in important categories for Site Selection Magazine. Let's look at Arkansas. So Randall Moore and a number of the Arkansas CCIMs know my feelings here. So remember, go back to that U-Haul and United Van Lines migration reports. Why were so many people moving to Arkansas last year and the year before? You were in the top 10. And look at the items. Number 4 for lowest cost of doing business. But look where you got crushed. They overweighted this life, health, and inclusion thing, gave you a number 43 ranking that says you're not very inclusive, you're not very ESG, you're not very DEI. What in the world does that have to do with top states for doing business is a head scratcher to me. Companies, that's not their primary variable that they're weighting right now. It is an important one that we look at, but these are not the metrics that should be overweighted in this type of analysis. Let's look at where Arkansas does really well. Well, look at number 3 down there in terms of workman's comp. Look at number 13 in terms of electrical power. You've got a number of categories where you're below 20. So how, again, do you end up with a number 43 ranking is just beyond me. So Arkansas, I'm in the camp. There's a lot going on in Arkansas that's not getting respect for. Let me give you another one. I shared this back a month or 2 ago when I presented to the Arkansas chapter. So Northwest Arkansas is offering, for even more skilled workforce, an offer of $10,000 to move to Arkansas and keep a job. And if you keep it 18 to 24 months, it's essentially forgiven. And let's think about why Arkansas might earn a higher ranking. So there's this little company called Walmart. It's headquartered in Arkansas. They're probably the number one logistics company. They're probably as good or bigger in at least the United States than Amazon in logistics. They are now the number one private employer in the United States and number one in 21 states. And so when your top employer in your state is arguably the top logistics company, the top e-commerce company, and the largest private employer in the United States, and you have them headquartered in your state, how you end up with a below 40 ranking is beyond me. And so Arkansas, you're not sitting back on that, and you're working to bring even more skilled workforce into your state, largely on affordability reasons. And we'll talk about places like Little Rock in just a minute. So here's Walmart that shows where they're the number one private employer in 21 states. They're number one in Texas, believe it or not. It's not an energy or oil company. They're number two in Florida, three in Georgia, four in Illinois, and number five in Arkansas. This is a powerhouse, and these aren't retail store jobs. These are well-paying e-commerce, fulfillment, logistics jobs for the most part in the Walmart organization today. So these are good jobs that really are accretive to your economy. So lastly, let's look at Tennessee here. So Tennessee was probably the only state in your region that got some respect. They got a number 5 ranking. So if you think Virginia, which I disagreed was number 1, but the number 2, North Carolina, number 3, Utah, number 4 was Texas. I think it's way low for Texas. And number 5, Tennessee. I generally agreed with those. And if you kind of look at Tennessee at the top there, where they ranked in the top states for business, cost of doing business, number 8, infrastructure, very, very important to e-commerce, logistics, everything that's driving our country, number 4. You also have the Tennessee Valley Authority. You have cheap and very reliable electrical power. But again, look at where you got hit hard. Life, health, and inclusion. So for whatever reason, the media and the importance I've talked about of our industry having to tackle and get on board with what this ESG and DEI means to our industry, Tennessee, they ranked you 46th in the bottom 5 in the country for inclusion, diversity, equity, all of that type stuff. And I go to Tennessee a lot. I deal with businesses. That is not my impression at all. You particularly go to Nashville, where you don't see that at all on that side. So Tennessee, you rank very well. Look at where we rank number 5. Again, utility power stuff. Number 15, workforce readiness. You think Amazon HQ2 would pick Nashville along with Boston to be all of its IT jobs if they didn't think you had skilled workforce ready for their IT. So these things just don't add up very well for me. Mississippi. So Mississippi, you get no respect at all. They might as well just call you the Rodney Dangerfield state. They gave you a number 45 ranking. But let's look at some of these things. Number 7, best state in terms of doing business. And then look at the site selection. Number 8, electric power costs. Look at number 14, skilled workforce readiness. You rank number 14. And so we hear all the time where Mississippi is in the bottom 5 in terms of education. When it comes to higher education, skilled workforce, adult workforce readiness, you rank in the top 15 in the country. And this is very objective, non-political, agnostic analysis by Site Selection Magazine. It's done very, very well. And then look at fiscal health. You're in the top 25 in terms of fiscal health. So hopefully this makes you feel a little bit better about your states. And even Mississippi, where you just generally don't get a lot of respect at all, there is an awful lot to respect. So I broke out, since Mississippi, you kind of get the bad marks more than any other state, particularly in your region, but nationally. So I broke a few things out. Your Mississippi Economic Council is a great website that really documents things that are going on. And I pulled out some recent Mississippi news items and looked at 2 major announcements. So on the left, Amazon announces Mississippi solar project is one of 3 initial US locations. So Amazon's only going to do 14 solar projects in North America and Europe. In the US, and one of the first 3 is going to be in Mississippi. So all of the technology, all that skilled workforce that I just talked about, you think Amazon doesn't know what it's doing when it picks you for one of only 3 initial locations? And then let's look over on the right there. Kohler Power is increasing its manufacturing capacity in Mississippi in Hattiesburg. So what Kohler's doing is these home backup generators for when our power goes out or you have a hurricane disruption. This is where they build them, in Hattiesburg, Mississippi. And Kohler is expanding, and they're going to bring their total capacity up to over 900,000 square feet. This is almost a 1 million square foot major manufacturer that's picked all of its apples and all of its emphasis and headquarters and operations in Mississippi. So I point this out. We need to know these things as CCIMs. We need to be able to tell this story when we're talking about our commercial real estate, when we're talking about our industrial assets, when we're talking about growth and population migration, because there is really a good story here. And there's a lot in regions 4 and 6 for all of your states to be proud of. And this is what I think is driving this move to the Zoom MSAs. We're moving from the coast. We're moving away from high cost of living towards affordability, towards quality of life, all of those things. And hopefully what I just went through here kind of shows you some of that story for your states. All right, so you should all feel good about your states. You should all feel good about regions 4 and 6. So let's back up a minute and look at what I call what a difference 6 months or a year can make. Think back when I spoke to you in January, at the beginning of the year, and said, look, if we want to forecast 2021, it's really going to be based on two things. Number one, it's going to be based on, do we get this vaccination situation under control? Because if you remember back in December and January, it was a complete cluster. We had just gone through the elections. We have a change of administration. There was a huge mess on supply chain. And so anyway, we got that under control. And I said, pay attention to travel, because if we get vaccinations under control, we're first going to go do leisure travel. We're going to get the heck out of our homes and we're going to go places. And so look at this. This is the TSA passenger count index that I told you to look at back at the beginning of the year. And so look back in January in the left column there, we only had about 30 to 40% of our normal passenger traffic of over 2.5 million passengers a day moving through the airports. Fast forward to right now in July, from the 4th of July weekend through current, and we're at 2.2 million. We are essentially back with the same number of passengers that we had before COVID in 2019. Delta this morning released its earnings. This is why I pay attention to earnings. We're at the beginning of earnings season, primarily the banks this week, but there's a few interesting ones. We had PepsiCo yesterday, we had Delta today, and Delta basically had a profit for the first time in June since 2019. It's forecasting its Q3 and Q4 will be completely a profitable situation on its balance sheet. And here's what's even more important. They're seeing that their business traveler, of all the ones they track, people like me, that 40% of all their business travelers like me from before COVID are back booking and flying flights. I've already done several in the last couple of months. I have 10 air travel trips coming up between now and October. So this is a very encouraging thing. It's first benefiting leisure, but the business traveler looks like it's coming back. So what a difference 6 months can make. This was Becker's hospital review in the New York Times that looked at states reopening. How many of us honestly could say back at the beginning of January that all but 2 states would be completely reopened 6 months from the beginning of the year? I wasn't anywhere near that optimistic, but that's where we are. New Mexico and Oregon are the last 2 states that are not fully reopened. New Mexico is just about there. Oregon, we'll just talk about another day. But anyway, this is an impressive story in what's driving our economy. And this is going to positively affect us in commercial real estate. And as part of this story, why you're not seeing a lot of blown up and bad CRE loan debt, because we really recovered so quickly because we got the vaccinations underway and we're back in full operating mode again. All right. I know we're talking about regions 4 and 6, and Hawaii is not in regions 4 or 6, but I put Hawaii in here. I did present to regions 1 and 2 recently, and I like the story in Hawaii because Hawaii was probably the state that was the most adversely impacted by leisure and travel because of COVID. So I called it the good, the bad, and the ugly. The ugly was at the beginning of COVID. Hawaii lost almost 100,000 jobs. Its unemployment rate went over 12%. It was a really ugly situation. It is now back to, it's recovered over 50% of its lost GDP. It's back down to a 7% unemployment rate. Look at the bad, which is where we were at the beginning of the year. And you can see that there was more hope than there was really reality. But look at the good right now. The power of leisure and travel is coming back. Hawaii lost 2/3 of its visitor expenditures, but it's recovered almost half of that in the first 6 months of this year. Hawaii is a proxy for what you're probably seeing in many of your states and in your cities. So Arkansas, Lake of the Ozarks, Texas, think of all the assets that you have there, either down in the Gulf or, the Hill Country or, Austin, and people getting out and going to entertainment again. It is back. It's back in a very, very strong way. And when you look at these numbers of why, this is how quickly leisure and travel is recovering. So if you need another example outside of your region to really show as a proxy, the University of Hawaii Economic Research Organization has one of the best sites in the country where they really track their leisure and travel, because they need to. But some of your states don't take it as seriously. And believe it or not, in your regions, over 10% of your GDP comes from leisure and travel. So it's very important to your GDP. All right, I want to pivot a minute on housing and talk a little bit about housing. The first and most important thing to think about on housing is we've already kicked the can down the road again. Freddie Mac and Fannie Mae have extended forbearance now to the end of September. So when you think about why we haven't had a housing recession, why we haven't seen more inventory come on the market, why we haven't seen a reconciliation for rent forbearance and mortgage forbearance, when 1 in 4 American households are either in rent or mortgage forbearance, it's because of the continuation of these intervention programs. So I've had a long-standing warning call for anybody on the multifamily side, either as investors or on the brokerage side, because I think a day of reckoning is coming. I don't think all the multifamily investors and property owners are going to get all their rent forbearance back. I think there's going to be a means testing where maybe those households that have 50,000 or less in income get rent forgiveness, and they're already starting to talk about that at Freddie and Fannie. Next, the median home value to income ratio. This is another reason what's driving people to the Zoom MSAs, where they can remote work, they can find affordability. It's because the median home value is so out of whack with their income ratio. And we're back to the record that was reached in 2006. And so this is part of that story why you're seeing this population migration into your region, into your states, into some of your MSAs. So what are some of those MSAs? This is a great resource when we talk about the Zoom MSAs. Rent Cafe has a blog, and they focus on really what's happening in the hottest rental markets in Zoom MSAs, secondary MSAs, and tertiary. And let's look at a few of them that are in your region. Knoxville, Tennessee. They rank number 9 in terms of hottest multifamily and most affordable. Little Rock, Arkansas. Here again is that Arkansas story that people don't give enough respect to. Memphis. So we think and talk a lot about Nashville, but we forget about Memphis and all that's going on there. So you are part of this story where your housing affordability, your rental affordability are very strong in your secondary and Zoom MSAs. All right. The one I'm not optimistic about is us going back to work. So at the beginning of the year, I talked to many of you about this thing called the Kastle key card system. They're the technology that has all of the key cards we use to get in and out of our office buildings, hotel rooms, and they can tell us who's coming and going at what rate. At the beginning of the year, back in February, only 24%, just under 24% of us on the left were going back to the office and using our key card. We're only at 31%, 6-7 months later. So think of everything else I just told you about, and leisure and travel, getting on airplanes, moving, all but 2 states fully open, yet only 31, less than a third of us are going back to the office. I'm not, and I hope I don't. So this is a metric to really watch, and I'm not optimistic about even in Zoom MSAs about the office market. I'm bullish on the suburban markets, and I'm bullish on secondary and tertiary markets, but I'm not in the big high dense MSAs that are particularly dependent on public transportation. New York, Boston, San Francisco, Seattle, I think they're going to face a real correction in office. So let's look at how this is playing out. Facebook recently just came out and said, look, everybody can apply for remote work. All employees can do it. They had one caveat, and this is important for you in your regions. If these employees move from expensive markets like Seattle to, say, San Antonio, Texas, or Austin for a tech job, or they move into Little Rock, these big tech companies are going to adjust your salary for a cost of living basis. And so if you move to a lower cost region, the salaries will be adjusted quarterly, highlighted in yellow in the middle. And the other thing is that these big tech companies are guiding to is that long term, they think that half of their workforce will be working remote half time going forward. So that's a whole lot less office space that we're going to need. There's a number of studies also in this slide 29 that look at what employees and employers are predicting. And this is already showing up in the JOLTS, the Job Opening Labor Turnover Survey, that shows that employees that are in jobs right now and their employers like a JP Morgan that are saying everybody's got to go back to work, you know what they're saying? See ya. 28% are already looking for new jobs where they don't allow remote work to get remote work. And JP Morgan in their earnings yesterday stated they may have to rethink this going back to work at the office because they're so efficient and they're achieving such investment banking numbers and earnings that maybe they don't want to screw it up and that maybe this remote work thing works. As far as the employers, 74% of chief financial officers say they plan to permanently have at least 5% of their workforce remote work. 76% of the companies say they will continue flexible work, and 43% of the companies will continue remote work. We're not going back to anything like 2019. And I think when we look back 3 to 5 years from now, the one commercial real estate property type that we're going to see was most adversely impacted by COVID is going to be office. It's not going to be hotel. It's not going to be retail. It's going to be office. This is a structural change, as much of a structural change as when the GIs came back from World War II. And in the 1950s, they said, we're going to create this new thing called a suburb and a regional mall. And for the next 3 or 4 decades, that's where the growth was. So next out there that we've got on this front, the Economist just did a big study, and they looked at this thing not just in the United States, North America, but Europe and globally. And what was interesting is they found that more than 103 million square feet of office space has already been vacated since the pandemic began. That is 18% more floor space than during the financial crisis. So this is a much bigger impact on office. And those that are just dismissing it, I think are really, maybe they're in the camp with the Fed where they can't find inflation and they can't find a vacant office. I'll help them find it. All right, let's pivot to something optimistic. Many of you have probably picked up, we released a new insights paper. We didn't have one last year during COVID, but thanks to the communications team and all the hard work at the leadership of the Institute, we got a new one out. And we did it on last mile logistics. And here's the paper, and it's on ccim.com/insights. And we're getting some great media coverage for CCIMs. So the communications team has been busy working with me. We had a really nice institutional real estate podcast that Larry set up, Larry Guthrie in Chicago yesterday that we did. It's a 45-minute podcast. If you don't want to read the whole paper, you can put this on and listen to it. It was really, really well done. We also got a nice piece from Globe Street that is a real quick read. You can read this one in about 5 to 7 minutes. That was done by Globe Street. And the quote that we got in there, that I was happy we got in there, many people think of your regions 4 and 6 in the Midwest overall as kind of flyover territory for those kind of New York to California financial, concentric and technology concentric industries. They just fly over and look down and don't know anything's going on in Arkansas or Louisiana or Mississippi. But we got them to be thinking that where you are, your regions are part of what really is the heart of logistics country. So very important identity banner. Like the old days, they called it the Rust Belt, that they've rebranded as the Trust Belt. The flyover territory in the middle part of our country, we need to rebrand that as that's the heart of logistics country. It's not flyover country anymore. So there's another big logistics story that's occurring that we talk about in the paper that impacts your region in a big way. And this is rail consolidation. So we have Kansas City Southern that is merging with Canadian National. They initially were going to merge with Canadian Pacific, which would have brought them from all of Canada down into the Mobile, Alabama region. But when they flipped that and went with Canadian National, it collects everything in Chicago and brings it down into Port Freeport in Texas. And this is amazing because this will be the primary T connection for railroads in North America that move east, west, and north, south. And logistics are going to follow this like mad. So those of you in Texas, this is a huge, huge story, particularly down at Port Freeport, Fort Bend County, Sugar Land, going down to Rosenberg, going down to Port Freeport. Port Freeport will become to Dallas what the Port of Savannah came to Atlanta. This is a major, major logistics story. I think it will also mean we'll see another rail merger within a year. Canadian Pacific will be forced to have to do a merger with one of our domestic Class 1 railroads, and I'm betting that's probably Norfolk Southern, which will allow them to bring everything down to Canada and then connect with Norfolk Southern and go into the Mid-Atlantic and the Northeast. So pay attention to the rail. We talk about this in the paper. These are some of the maps showing the different lines that are going on. You don't think logistics is a big deal? Sam Zell just put his stamp of approval on logistics. So Sam's a CCIM, and I'm a director on an industrial logistics public REIT known as Monmouth. And Sam Zell is we're merging with his EQC REIT. And he has basically said, I'm going short on all my office assets. I'm selling even my good office assets in Austin and Denver and DC, and I'm going all in on logistics. And so when you get someone of that horsepower that's had that magic touch in real estate saying, I'm done with office, I'm going all in on logistics and industrial, that's a pretty powerful statement. So why am I spending so much time on this logistics? Because we're going to have an infrastructure bill probably by Labor Day and voted on before the end of the year. And the White House has a fact sheet that talks about what it's going to do. Well, earlier this year, we did a podcast on the American Society of Civil Engineers annual quadrennial infrastructure report. And they identified, look, we have 173,000 miles of major highways that need repair, 45,000 bridges. And in the Biden administration infrastructure bill, they're proposing only to address 20,000 miles of the 173,000 of roadways and major highways that need repair, and only 10,000 of the 45,000 bridges. Is what we call the hard infrastructure versus soft infrastructure. So they're redefining this. Hard infrastructure, roads, bridges, ports, rail, that drives the value of commercial real estate. As a part of the real estate industry, CCIM's an affiliate of NAR, we need to be knowledgeable of what's going on here. We need to be engaged. We need to be able to provide factual information to our House and Senate leaders so they can evaluate this bill in addition to our looking at our fiscal situation. I want to show you another reason where we hear kind of the supply chain is all because the ports are screwed up. In particular, I told California, this is something to be very proud of. The Port of Los Angeles just broke a Western Hemisphere record. They're the first port in the Western Hemisphere to handle 1 million containers in a month. And they'll probably do it again every month through the summer into the fall here. Here's a picture of it. This is an amazing accomplishment. Our ports are working very well, but they've been put under a logistics and e-commerce pressure that was supposed to build out over 5 to 7 years and it's been compressed to 1 or 2 years. So tip of the hat to California and LA and Long Beach, that are our busiest container ports, but in the Gulf region, particularly Texas, Louisiana, Mississippi, your ports are very, very important and growing. And the rail infrastructure. So Little Rock has an important inland port that ties into all of this rail and the port stuff. So logistics is very important to your region. I put some of the resources here. These are also covered in the Last Mile Ward Center course that we developed and released in January. So if you hadn't had a chance to look at this, these are some of the things I pay attention to help me keep tuned up on all the facts. Most are either free or very cheap, maybe $100 a year for subscription. So I'll wrap up with this. This is my son, Luke. He's a very special needs kid that we adopted as a newborn. So he just turned 11. And Luke gave me some good advice. And he said, Dad, quit working so hard, quit stressing about everything, just sit back and have a root beer with me. So here's Luke enjoying a nice, cool root beer on his 11th birthday. And he reminded me there'll be plenty to worry about come this fall when we get together in October in Pittsburgh. So my recommendation for the rest of the summer right now, just sit back, enjoy where we are with COVID, enjoy what we've covered, enjoy a lot of the good economic news, have a root beer, spend time with family because we'll have plenty to worry about at the end of the year. This is a little bit about my Red Shoe Economics company and my partner, Beverly Keith, that without her, I don't think I could keep my my oars in the water. Very valuable. This is some of the stuff that we do. And with that, Larry and Region 4-9, I'll turn it back to you. Appreciate everything. And I'll stop sharing my screen in case there's any questions.
K.C., this is Tim Beeler. Thank you so very much. And thank you for the wonderful presentation. We have time for a few questions, and there was a couple that came to the chat box. First one KC, is over to it. This is from Angela Hodge. As working with investors, what are the best opportunities to invest in? For example, warehousing, strip centers, industrial, etc. And then in addition, she says, also, can you touch on the best states for cannabis and hemp?
Okay, boy, no tough questions from Angela. Thank you, Angela. So one of the best secrets I'll give you that combines both retail and warehouse that we covered in the last mile course, and we actually covered in this new paper, is an acronym called RICS, R-I-C-S, stands for Retail to Industrial Conversion. And what's happening in this last mile is companies like Amazon are trying to design a last mile logistics program that's kind of like electricity coming to our house. You have the big electric power generating plant that then moves across high transmission lines to substations, which might be our warehouses, and then they need to scale it down with a smaller transformer to give the power at a wattable level to come into our homes. And so what they're realizing is Amazon and FedEx have all the data to know where the density of packages are going in our cities and our states. And what they're doing is they're looking for those empty retail assets, those big box. Forget the malls. They're too complicated. We're not going to get the malls converted. You don't control all the land. The department stores own certain pieces, but a freestanding big box, 30 to 50,000 square feet, an old Kmart or whatnot, that's in proximity or in a zip code that has high density of package delivery, household purchasing, online purchases, use your site to do business skills. That's what they're looking for. And so I used in our ward course an example in Hampton, Virginia, where Amazon bought a Kmart, and they bought it for around 50 to 60 bucks a square foot. They put 10 bucks a square foot into it to put skylights in the roof, upgrade the paving from asphalt to concrete. They then went and put a 20-year triple net Amazon credit lease on it, and they did a sale lease back and sold the thing for 120 bucks a square foot. They got all their capital back plus enough to do two more. And so they're called retail to industrial conversions. If you use your site to do business tool and skills, you can do some of this in the community profiles and looking at where leakage is. Also in the earnings reports, FedEx and Amazon leak out in their 10Qs some of this information. And so that's one opportunity I would look at, rather the competing with the big developers, the REITs like Prologis or our REIT for these big 500,000 to 1 million square foot deals is going to be difficult because the tenants, the Home Depot, the Amazon, et cetera, they go directly to the merchant developers and they bypass a lot of us. So we don't get a good chance at that. Some of you that do capital markets work might, but they're also looking for these empty big boxes that are in locations that have high density of package delivery. In terms of states that are good for cannabis or hemp, I'll give you my favorite recommendation. Florida is doing it absolutely right. They didn't go Colorado crazy, and I grew up in Colorado. They're allowing it, is differentiating between hemp. They're not allowing the raw product to be sold like in Colorado, where you can do anything you want and make your own, brands or recipe mixture. So they're controlling it very well. They're not creating the criminal and other adverse problems, and they'll realize quite a bit of revenue from it. So I think Florida has the best model. I think that California and the Pacific Northwest are going a model that is going to be more problematic and a lot like what Colorado experienced. I think Colorado would like to do a do-over, especially when they look at the unintended consequences of it. So I hope that kind of helps on those two.
KC, that was perfect. Thank you. There was an interesting comment in the chat box regarding diversity. Have you come across any research regarding diversity and that being a driver for relocation? And if not, what are your thoughts on this topic?
So yeah, so corporations are giving a lot of lip service. We saw it with the Major League Baseball leaving Atlanta, going to Colorado. So because of Georgia's new voter law, which is much more inclusive and diverse than Colorado's or the president's home state of Delaware. So we've seen that already in entities like Major League Baseball. We've seen companies like Coca-Cola and Delta speak up, but they didn't move. Delta didn't move its hub out of Atlanta. Coca-Cola didn't relocate any bottling plants, but companies are getting much more engaged around it. where I think you're going to see the impact is more around the lines of hiring rather than site selection, but it's starting to become a site selection item. This thing by CNBC where they introduced this new, life, health, and inclusion category and weighted it so heavily to really hurt states that are doing well, Florida, Texas, on their overall state for doing business. They're trying to inject this ESG DEI thing into the site selection equation. And what we need to be aware of in the real estate industry, I think over the next 3 to 5 years, it will become a site selection variable and criteria. Right now, it is more to do with hiring, appointing directors to the board, and for us in real estate, us getting hired as a vendor or a broker. Because if you don't have an ESG DEI category or tab on your website, you may already be screened out of consideration for multi-state, multi-city brokerage assignments, property management assignments, appraisal assignments. You'll notice on our Red Shoe Economics thing, I try to walk the walk here. I'm the only one of me in my company. I'm an aging old white male with gray hair. Everybody else in my company is a woman, very sharp, and we'll have all CCIMs hopefully after October that are in our company. So we're a majority minority women-owned business or majority woman-owned business. We need to be thinking about those things. It's coming very, very quickly. But right now it's limited more to hiring, the composition of your board of directors, whether you have something about ESG on your website, but it will become a very material ESG category. I'll give you another one, Mississippi on that solar project. Places like Mississippi, where they're trying to create economic opportunities and diversity and inclusion, are looking at projects like solar, or battery technology or whatnot to put in places to give those communities in those states an economic opportunity, and they'll get credit. We are going to see ESG credits, just like we saw the evolution of wetland credits to do redevelop coastal and wetland areas. So it's coming very, very quickly. I haven't seen any company yet that's put it out there that they made a site selection decision where ESG was the tipping point, but it's coming. It's coming very quickly.
K.C., that was perfect. Thank you again for everything. Thank you for sharing your expertise with us today. And thank you to everyone out there joining us. As a reminder, the recording and accompanying presentation will be emailed to all registered attendees. And if you're not already a CCIM Institute member or course participant, take a moment to sign up for our e-newsletter at ccim.com to stay informed about our complimentary webinars like this great one, as well as other professional development opportunities. K.C., you hit it out of the park as always. Thank you, brother. Well done. And everyone out there, have a great day. Thank you.
Have a root beer.
Have a root beer. I will do that.
And I'll treat, and if everybody comes to Pittsburgh, I'll treat the root beers. Thank you.
Thumbs up from the Beeler household.
Thank you.